On the 10th of March 2020, a Finnish oil refiner agreed to buy a family business in the Chicago suburbs. It closed on the 4th of May. Terms were not disclosed. The company was Mahoney Environmental. It had been collecting used fryer grease since 1953. The founder's son was still running it, and there was no brand anybody outside the trade could name. The buyer was Neste, which had built renewable diesel capacity and needed feedstock for it. The one thing a refinery cannot do, at any capital budget, is manufacture a gallon of used cooking oil. So, a refiner bought a 67-year-old truck fleet in Illinois rather than build one of its own. In a trade that spent most of its life being paid to haul waste away, that is a strange thing to be unable to build. How it became unbuildable took 67 years, and it starts with barrels. In 1953, when 55-gallon barrels were still the transport norm, a family in the Chicago area started collecting fryer grease. By the trade's own account, the money ran the other way then. A restaurant paid a renderer, a company that boils animal and kitchen fats down into raw material, $15 to $30 a month to take the fryer oil away. It was a disposal cost, filed next to the dumpster contract, and nobody puts a padlock on a dumpster. A collector in that world grew the only way this business still grows, buying smaller operators and inheriting their stops. Mahoney did that for 2 generations. The profile that put numbers on it had it at 40% of the Illinois market and 8% of the country, which tells you the roots had long since left Illinois. So the asset was a list of back doors, assembled one kitchen at a time, in a business whose customers were paying to be rid of the product. Something had to happen to that product for the list to be worth a refinery's money. What happened is that the oil got a published price. Every Friday, the Department of Agriculture's Market News Service prints a page of feedstock quotes, and yellow grease sits on it, the trade name for used cooking oil once a renderer has cleaned it to spec, low-grade animal fat sometimes included. It is quoted in dollars per hundredweight, which is 100 pounds, so the same number is also cents a pound, which is why this trade talks in cents, never in gallons. Read the series and it is not a steady climb. In January 2023, mid-renewable diesel build-out, Minnesota yellow grease averaged 59.56 cents a pound, and California's San Joaquin Valley 60.75. 12 months later, the same 2 quotes read 32.25 and 36.32. Minnesota had lost 46% of its price in a year, San Joaquin 40. Now the most recent quote. Minneapolis, 48 to 64 cents. Los Angeles, 63.5 to 65.5, against 33 to 35 in the same report's year ago column. The middle of that Los Angeles quote went from 34 cents to 64.5 in a year, 90%, which is why there is a padlock in the alley now. Behind almost every restaurant in the United States, there is a steel bin with a lock on it, and the largest collector in the country sells that bin in 3 sizes, its catalog listing the lid as a theft-deterrent locking lid. Take the smallest. 200 gallons is about 1,500 pounds of oil, and at the price the Department of Agriculture published for the week ending the 24th of July, 2026, a full one holds $720 to $960 of commodity, once rendered. The restaurant does not own that bin, did not buy it, does not pay to have it emptied, and is, in many cases, paid for what goes into it. Somebody else set it down, hung the lock, and holds the key. That payment is the disposal fee running backwards. Large chains now receive a rebate on the pounds they hand over. Small independents get free container placement and nothing else. Baker Commodities, one of the larger renderers, publishes the mechanism but not the number. The rebate is per pound, and it moves with oil quality, contamination, and the regional market. Nothing about fryer oil changed across those 70 years. What changed was what a gallon of it was worth once it reached the far end of a pipe, and who was allowed to sell into the United States. Between them, those two turned a list of backdoors into an asset, so it is worth being exact about what sits on the list. The container gives the structure away. Darling Ingredients tells the Securities and Exchange Commission that used cooking oil is supplied to the company under mutually agreeable contract terms, in proprietary self-contained collection systems, housed inside or outside the building, with the oil from the indoor ones pumped straight into the collection vehicle through an outside valve. Proprietary and self-contained, placed by the collector, at the collector's cost, on a schedule the collector sets by how much oil the location generates. Reporting on Neste's American routes put the busiest sites at a visit every 3 weeks. So what you would actually be acquiring here is not a bin and not a truck. It is a list of kitchens that have agreed, in writing, to hand their oil to you and to nobody else. The state has an opinion about that list, too. Under California's Food and Agricultural Code, anyone hauling inedible kitchen grease registers with the state and hands over a description of the operation, the vehicles used, and every driver by license number. The fee runs up to $250, so the money is beside the point. What the state wants from you is a named truck and a named driver on every load, because the oil's value downstream depends on proving where it came from. Now price one entry on that list. Two sources, 5 years apart and unconnected, land in the same place. Reporting from 2021 put one busy Burger King branch at 8,000 pounds of used cooking oil and grease a year. Restaurant Technologies, reporting its 2025 results, recycled over 393 million pounds across more than 45,000 customers. Both are floors, so the division is rough. It lands near 8,700 pounds per location. 8,000 against 8,700. Two unrelated numbers, 9% apart. Take the middle of that week's Minneapolis quote, 56 cents a pound. And one contracted backdoor is worth $4,480 a year at the lower yield, $4,872 at the higher. That is the rendered quote, what the pounds fetch after a renderer has cleaned them to spec, not what they fetch at the back door. That is the whole top line of one restaurant before the truck and the driver come out. It is also the denominator you will price the business against. A refiner paying the top of that week's quote, 64 cents a pound, for rendered fryer grease looks like an error until you see what it is buying. Half the answer is price. In that same report, that same Friday, crude soybean oil in Illinois was quoted at 75.59 cents. Waste oil was the discount option. The other half is a compliance position, and the fat is almost incidental. Renewable diesel from waste oil earns credits under the Federal Renewable Fuel Program. They are called RINs, short for Renewable Identification Numbers, and a refiner who does not blend renewable fuel buys them from somebody who does. How many a gallon earns is written into the Code of Federal Regulations. Title 40, Section 80.1415 gives ethanol an equivalence value of 1, biodiesel 1.5, and non-ester renewable diesel above a stated heating value, the hydrotreated kind made from fats and used cooking oil, 1.7. On the 4th of June 2026, the Energy Information Administration put a biomass-based diesel credit at $2.41, close to its all-time high. Its own words for the move. Those credits had doubled in value since the start of the year, after the Environmental Protection Agency's final blending rule for 2026 and 2027 landed in March. What follows is illustrative arithmetic on two published figures, not any company's disclosed economics. 1.7 credits at $2.41 is $4.10 riding on a single gallon. Now price the oil it was made from. At 7.5 pounds to the gallon, the benchmark the trade uses for biodiesel, and at that week's Minneapolis quote, it cost $3.60 at the bottom of the range and $4.80 at the top. So at the top of the quote, the paperwork is worth about 85% of the oil. At the bottom of the same quote, in the same report, on the same Friday, it is worth about 114%. Somewhere inside 1 week's price range for fryer grease, the credit attached to the gallon becomes worth more than the gallon. And that is before California's low-carbon fuel standard, a separate state market where credits changed hands at around $70 each in the week ending the 8th of March 2026, on trade reporting of the regulator's transfer data. And before Section 45Z, the federal clean fuel production credit, worth up to $1 a gallon depending on the fuel's emissions score. All three are settings, and settings move. The same final rule that doubled the credit price also cuts the equivalence value for renewable diesel from 1.7 to 1.5, effective the 1st of January 2027, unless a producer petitions its way back up. Same gallon, same oil, same refinery. $4.10 of paperwork becomes $3.62, because a table in the Code of Federal Regulations changed. The price of used cooking oil is set in a credit market the collector never touches and cannot influence, bolted to the far end of a pipe that ends in a refinery. If you owned every bin in America, you would still not own a single input into it. Frying volume tracks what people eat. That is the ceiling on how much of this oil exists at all, and it is set in dining rooms. What price does move is the recovery rate, the share of the oil a country cooks with that ends up in a bin rather than a drain or a plate. Clean Fuels Alliance America commissioned LMC and Global Data to size world supply in 2023, and the report is blunt about it. Supply is linked directly to consumption of fried foods, it says, and the volume collected and available for use is then driven by incentives and regulations. Rising prices have been incentivizing increased collection, so the pool can grow. It grows like a ratchet, one notch at a time. That study puts American recovery at about a quarter of the oil used in food, says there is some room for growth in the collection rate, and forecasts United States supply climbing from 0.85 billion gallons in 2022 to around 1.1 billion by 2030, 3% a year. That is what maximum effort looks like here. Now the pool as it is consumed. The Energy Information Administration tracks the feedstocks American biofuel plants burn, and its yellow grease line, which its own footnote says includes used cooking oil, came to 7,387,000,000 pounds in calendar 2024, worth roughly $2.4 billion at the January 2024 quotes, the bottom of the market, and over $4 billion at this July's Minneapolis midpoint. Same pounds, same kitchens. Every gallon already sits behind somebody's back door, under somebody's contract. When demand rose against a supply that could only inch upward, the market moved oil that already existed. Every strange feature of this business comes from that. It showed up first in the competition for stops. Taking a competitor's stop is the fastest way to add pounds, and competing for stops is what turned that disposal fee around. The same pressure arrived by ship. The United States imported a record 1.27 million metric tons of used cooking oil from China across 2024, worth about $1.1 billion, and on Agriculture Department figures, that was roughly 43% of everything China exported. That tonnage is on the order of 2.8 billion pounds, close to 38% of the yellow grease pool American plants consumed that year. Then came Section 45Z's feedstock rule. For fuel produced after the end of 2025, the credit requires North American feedstock, and the certification model has no route for imported oil pending Treasury guidance. The collapse ran ahead of it. Chinese imports fell 65% over the first 8 months of 2025, and the Energy Information Administration's consumption figures for the first 9 months annualize about 30% below 2024. If you had held routes in 2024, more than a third of the competition for pounds was arriving on a boat. Inside a year, 2/3 of it was gone, and the middle of the Los Angeles quote was 90% higher than the year before. And it surfaces as theft, which reads as a supply signal. The renderer's own trade association put annual American losses at $300 to $500 million in an estimate dated the 24th of October, 2025. Called that conservative, resting on member data and anecdote pending a formal study. A federal grand jury in Raleigh charged 21 defendants in June 2019. One in Des Moines returned a 9-count racketeering indictment over stolen fryer oil in December 2025, and the superseding indictment names 19. Those are charges, not findings. A crew holding 0 contracts can physically reach oil that is otherwise spoken for, kitchen by kitchen, in writing. When the cheapest way to get pounds is to take somebody else's, the pounds are the scarce thing. One operator solved the padlock by deleting the object. Restaurant Technologies has been running since 1999 on a closed loop. Its installers put 2 tanks in the back of house and plumb them into the fryers, one for fresh oil and one for used, with sensors that tell the company when the fresh tank runs low. Its trucks deliver bulk oil into one and draw used oil out of the other. There is no bin in the alley. In 2025, it moved almost 720 million pounds of fresh oil out and got 393 million back across 41 depots. Its own frequently asked questions page says you get the equipment with no capital expense, maintenance and service included. So the company owns the hardware and recovers it through the service agreement. Neither the equipment nor the agreement carries a published price. A padlock on an outdoor bin and a pipe plumbed into a fryer do the same job in 2 forms. Both hold an account in place, one by making the oil hard to take, the other by making the service annoying to replace. One filed number is worth setting against the margin folklore. Darling's feed ingredients segment, which its filing says covers the fats, proteins, used cooking oil, and trap grease collection business, booked $613.9 million of segment-adjusted earnings before interest, tax, depreciation, and amortization on $3.99 billion of net sales in the year to January 2026, a 15.4% margin on a segment far broader than the grease routes inside it. Read it as a ceiling on the neighborhood rather than as a margin on a truck. Which brings the story back to March 2020. By then, every gallon Neste could refine had to come out of somebody's kitchen, and every kitchen worth collecting from was already on somebody's route, so it bought a route. Nobody in that transaction lost. A family firm sold something that could not be built from scratch to the only kind of buyer for whom it was worth more than its trucks, and it was one of three. Darling Ingredients completed its acquisition of Valley Proteins on the 2nd of May 2022 for approximately $1.1 billion in cash. Darling's own announcement sets out what came with it: 18 rendering and used cooking oil facilities across the southern, southeastern, and mid-Atlantic states, 1,900 employees, and a fleet of 550 vehicles. The stated reason, in its chief executive's words, was feedstock to fuel growing renewable diesel demand. 6 weeks later, on the 13th of June, Chevron completed an all-cash acquisition of Renewable Energy Group for $3.15 billion, citing the target's feedstock capability against a goal of 100,000 barrels a day of renewable fuels by 2030. 3 buyers with renewable diesel capacity behind them inside 26 months, each buying a collection company rather than building collection. In this trade, the buyers are the customers, and customers only buy their suppliers when the supply is the scarce half. If you were building here, those are the people you would sell to. There are about 3 of them. This is education and entertainment, not financial or investment advice. Start at the top of the chain, because that is where the ceiling is easiest to see. Diamond Green Diesel, the joint venture between Darling Ingredients and Valero, sold 1.003 billion gallons of renewable diesel in the 12 months to the 31st of December 2025, against a production capacity Darling's filing puts at about 1.2 billion gallons a year. Now run an illustrative conversion with the assumption said out loud. At 7.5 pounds of oil to the gallon, and setting aside that renewable diesel yields are not exactly 1-to-1, a billion gallons implies around 7.5 billion pounds of feedstock. The national yellow grease pool was 7.4 billion pounds in calendar 2024, a year earlier. One joint venture on fryer oil alone would need more than the entire national supply. It runs on animal fats and corn oil instead. Growth here is a question of capacity, and capacity has a price. The truck is the cheap part. A new heavy vacuum tanker runs $150,000 to $275,000 on the ranges commonly quoted in the trade, with another $10,000 to $20,000 of pumps, lifts, and routing hardware on top. Call it $160,000 to $295,000 all in. It ships, and it adds 0 gallons to the national pool. So price what the buyers actually paid. Darling's $1.1 billion came with 550 vehicles, the only one of the 3 deals where both the price and the fleet count went on the record. Divide one by the other, $2 million a vehicle, nearly 7 to 12.5 times what the truck and its gear cost new. That division is an illustrative allocation and nothing more. The same money bought plants, people, and a rendering business, and those trucks carry animal byproduct too, so attack it. Allocate only half the price to the fleet, and it is still $1 million a vehicle, nearly 3.5 to 6.25 times a new truck. Keep both numbers, because the next step has to survive both. Now count what one truck stands in front of. The range the trade commonly quotes is 15 to 30 stops a shift. At roughly 20 shifts a month, every account serviced monthly, one truck holds 300 to 600 contracted back doors. Put the 2 per account figures from earlier against those 2 counts, and that route collects $1.3 to $2.9 million of oil a year. That is the ceiling on one truck, gross, before a single cost comes out. Now do the division out loud. $2 million a vehicle, divided by the $2.9 million a big route grosses, is 8 months of gross oil. Divided by the $1.3 million a small one grosses, 18 months. Halve the allocation, and it is 4 months to 9. Between a third of a year and a year and a half of every dollar that route collects handed over once, in cash, before the driver and the fuel. Now move the one input everything above rested on. This is illustrative, and both prices are already on the record here. All of that ran on 56 cents. In January 2024, the Minnesota quote averaged 32.25, which is about 58% of it. Walk the same ladder down that number. Every account, every route, every gross figure shrinks in the same proportion, and that per vehicle figure stops being 8 to 18 months of gross oil. It becomes 14 to 31. Same kitchens, same trucks, same signatures. The quote moved, and the quote is set somewhere the collector cannot reach. Either way, that is what it costs to raise the ceiling by one truck. And notice what the money did not buy. The tanker was a couple of $100,000, available from a dealer this quarter. The other $1.8 million bought the 300 to 600 signatures that make the tanker worth running, in a country where the pool grows 3% a year. So the honest price of one more truck here is quoted in months of collected oil. 8 to 18 at the full allocation, 4 to 9 if you insist half the money bought something else, 14 to 31 if the quote returns to its January 2024 level. A tanker is inventory, and you can order one. A route is not, because every gallon it draws on is already spoken for. What that money buys is an existing share of a supply that will not get much bigger, which is the conclusion 3 separate buyers reached inside 26 months, every one of them free to build instead. No price for the Mahoney position was ever printed. What the family sold was the list itself, and its whole value was that the gallons behind those back doors were already spoken for. Nest could build a refinery to run on those gallons. It could not add one of them to the country's supply. The steel bin behind the restaurant does the job the barrels did in 1953. What stands behind it now is a refinery.